Okay, now in these videos, we are going to look at chapter 4, divestment. In the last few videos, we've been looking at expansion strategy, a company growing. Now, on the opposite, a company may downsize. Yeah? So if a company has many branches or department, but one of the branches is not doing well, making losses, so you may decide to close down one branch or sell it off or downsize the company if the whole company is not doing well. Okay, so that is called divestment. So instead of growing, it becomes smaller. Yeah, divestment strategies. There are many different strategies of divestment. It include sell off one branch, okay, sell off to a different party, sell off to your management team. We call management buyout. Okay, so there are different ways of divestment. There are notes here for you to go through. Okay, or just simply close down. If nobody want to buy, you just simply close down one department or one subsidiary. Okay, or you reconstruct, downsize, do a bit of restructuring. Yeah, so there are different way of divestment, which the notes here give you all the different options. Yeah, so do a bit of reading. You can get some discussion questions. Okay, so what is management buy-in? What is management buy-out? Yeah, okay. Now, and okay, you can also get computation question that asks you to evaluate a divestment strategy. Okay, I have one exam question here we'll go through. Yeah, there's no new additional knowledge. Everything you need to do this come from your knowledge in chapter 1, cost of capital, and also your knowledge in chapter 3, the valuation techniques, dividend model, earnings model, free cash flow model. Yeah? So there's nothing new in the technical knowledge. Everything you have learned, just apply. Yeah? So therefore, we can just finish off this chapter 4 in just one video. Okay, right. Look at the question. Coeden, a listed company operating in hospitality and leisure industry. Coeden, board of directors met recently to discuss new strategies for the business. The proposal put forward was to sell all hotel properties that Coeden owns and rent them back on long-term rental agreement. Okay, this company, it says here, you have some hotel properties, and in this property, you run hotel business. Okay, now you propose to sell off the property. So divest, yeah? But you will still need the property, so you lease back to operate your hotel. So you only focus on hotel service now. Okay. Coeden would then focus solely on hotel services at these rented properties, okay, under its popular brand name. The proposal stated that the funds raised from the sales of the hotel properties would be used to pay off 70% of the outstanding non-current liabilities, and the remaining fund used for future investment. Okay, so the non-current liability you can see here. Okay, you pay off 70%, right? So the balance will be 12,600. Okay. The board of directors are of the opinion reducing debt in Coeden will reduce the company risk and therefore cost of capital. Lower risk, lower cost of capital. If the proposal is undertaken, Coeden focuses exclusively on provision of hotel services. It is assumed that the current market value of equity will remain unchanged after the proposal. Okay, so assume no change. Extract from the most recent statement of financial position. Share capital, 25 cents per share. So 1 unit is 25 cents. $1, there are 4 units. So the number of shares will be 13 million, yeah? Okay. Coincident latest free cash flow to equity. This is FCFE times 0 latest. 2.6 million estimated after taking into account tax interest and reinvestment in asset to continue with the current level of business. It can be assumed that annual reinvestment in asset to continue with the current level of business is equivalent to amount of depreciation. See, this statement you see in the previous question. Yeah. Okay. Over the past few years, Coiden has consistently used 40% of its free cash flow to equity on new investment while distributing the remaining 60%. The market value of equity calculated on this basis of the free cash flow to equity model provide a reasonable estimate of the current market value of Coiden. So to value the company, you are asked to use FCFE. Yeah. Okay. So this one is FCFE. The bonds redeemable at par in 3 years' time and pay coupon on annual basis. Although the bonds are not traded, it is estimated Coiden current debt credit rating is BBB, but will improve to A+ if the non-current liability reduced by 70%. Other information, Coiden current equity beta 1.1. It can be assumed the debt beta is 0. The risk-free rate is 4%. The market risk premium, RM minus RF. There's no beta available for company offering just hotel services, since most companies own their own building. The average asset beta for the property. Okay, this is asset beta property. The business risk for property, 0.4. It has been estimated that the hotel service business accounts for 60% of the current value of Coiden and the property business the remaining 40%. Coiden corporate tax 20%, 3-year borrowing credit spread A+ is 60 basis points or 0.6%, 90 basis points, 0.9% for BBB. Okay, over the risk-free rate. Now, calculate and comment on Coiden cost of equity and the weighted average cost of capital. So you want to find this one and this one. Okay. KE and WACC. Calculate and then comment the changes. Yeah. Before and after the proposal. All right. Okay. So it's actually a question computing WACC. So it's chapter 1, but in the context of divestment. Yeah. Okay. So, right. Okay. It's actually a question on WACC. First, before the proposal, current, yeah? So first is current, okay? Same thing, the 3 steps. Okay. Cost of equity first. Okay. Okay, the risk-free rate. %4, risk premium 6%. Yeah, beta now is 1.1. everything is given. So it's 10.6. Okay. Step 2, the cost of debt. The cost of debt, okay. Now, they give you credit rating. So it's the government bond yield, risk-free, plus the credit spread. Yeah, okay. Risk-free is 4. The credit spread now is triple B. Now is triple B. Yeah, and triple B spread is 0.9%. Okay. Triple B, yeah. So that's 4.9%. Okay. But must adjust to after tax. Corporate tax rate is 20%. Okay. Corporate tax rate is 20%. Then review ACC. Cost of equity 10.6. Cost of debt after tax 3.92. Yeah. Okay. And now we need the market value. Okay, we need the market value. Okay. Right. Okay. Now, the current market value of equity. So we start with VE. Okay. The current market value of equity is share price times number of shares. But the problem is the question do not give us the current share price. We don't have, yeah, there's no current share price, but they say this, okay, market value of equity calculate using FCFE, okay, using free cash flow to equity model. So this is based on FCFE, right? Okay, now FCFE, we have learned this, the free cash flow to equity now, plus a growth rate, divided by the cost of equity minus a growth rate. The free cash flow to equity now is given in the question. 2.6 million. Okay. 2.6 million, yeah. All right. Okay. Cost of equity we have just calculated is 10.6%. So it's 10.6%, yeah. 0.106, okay. Now, the growth rate. We need to get the growth rate because it's not given. Okay. Okay. Now, the growth rate, to find the growth rate, we know two ways. One is based on the past cash flow. Okay. Use compound interest. Another one is Gordon's. Okay. You look at the information they give us. They say this. 40% on new investment. So you reinvest 40%, you distribute 60% as dividend. This is the B, earnings retention. This is the B, right? So when you see this earnings retention, yeah, or the dividend payout, you pay out 60% dividend, you retain 40%. That tells you you use Gordon's. Yeah, when you see this information, okay, it's a clear indication of Gordon's. Okay, so BR or RB, yeah, the earnings retention is 40%. Okay, okay. The R is the return on equity. Okay, R is return on equity, ROE. Yeah? Okay. ROE is profit after tax divided by the equity capital based on the accounting information. Yeah, this is Gordon's is accounting model. So profit after tax divided by the equity capital in the balance sheets. Yeah. Now, okay. If we look back to the question, equity we know share plus reserve. This is equity. Yeah, share price reserve. Okay, but profit after tax or earnings is not given in the question, right? Profit after tax, this is not given. We don't know this. Okay, now therefore we cannot find. Yeah, okay, which is something common when it tests you on Gordon's model. Okay, if you cannot find this, you make an assumption. Okay, you made this assumption. Because KE, cost of equity, is the required rate of return, right? Cost of equity is the required rate of return for the shareholder. So ROE is the return for the shareholder. Yeah. So you can just assume that it is the same as the KE. So I put KE here. Okay. If you can find, you must find because they are not the same. Yeah. So ROE is the forecast return or the actual return. KE is the required return. Yeah. So if you have PAT, you must find. But you don't have, we make an assumption. This is quite common in your exams. Yeah. Either they give you KE, then they don't give you ROE. Or if they give you ROE, you are not able to find KE, you just assume they are the same. This is common. Yeah. Okay. Normally can only get one of them, right? You can get both, of course, you get both separately, but normally you can only get one. Therefore, the growth rate will be 0.042. Okay, 0.042. Yeah, okay, done. It's 42.33 million. Okay, 42.33 million. All right. Okay, it's done. Next, the debt. Okay, the value of debt now. The value of debt, they give you bond. This is the debt 5.2% bond, redeemable at par in 3 years' time. Yeah. Okay. They don't give you the market price, but with the coupon, with the maturity year, you can do a valuation to find the current market value. Okay. So, right. You don't have the market price given, but you can do a valuation to get the price. So we need to do that. Okay. And start from year one. Valuation is the present value of future interest and redemption value, right? Okay. 5.2% of the nominal $100, interest is $5.20, right? In the third year, 5.2 plus redeem at 100, 105.2. Okay, then we discount to the present value, right? Okay, the discount rate is the cost of debt, 4.9% before tax. Remember, valuation, we ignore corporate tax, yeah? All that we done in chapter 1, okay? So this is 4.9%. Or you can write up to 5%, yeah? Okay, okay. 4.9%, or you can write out to 5%, yeah? But you use spreadsheet function, then you don't have to round it out. Okay, 100.79, yeah? Okay, therefore, the total market value of that is the current price per 100 nominal times by the total nominal value in the balance sheets. The total nominal value is 42 million. Yeah, 42 million. Okay, that's 42.33 million. Okay, okay, which means, yeah, the equity is 42.33. The debt is 42.33. In other words, I can say is half-half, correct? Yeah, this same, 50%, 50%. That's the capital structure. 50% equity, 50% debt, okay? Right. So it's 50-50, yeah? Total is 100, right? Total is 100. Okay. So that will give me WACC of 7.26. That's now. Okay. Okay. Then after, right? After the proposal. So the proposal is sell properties, sell off the hotel property, and then pay back 70% debt. All right. Repeat the 3 steps. Risk-free, risk premium 6. Okay. Beta, we need to do beta adjustment. Okay. D-gear beta adjustment, the same process. First, de-gear the current beta equity of Coiden. The beta formula. Okay. The current equity beta is 1.1. Okay. The capital structure now is 50-50, right? 50% equity, 50% debt. Tax is 20%. That beta 0. Okay. So that will give me asset beta of 0.61. Okay. And Coiden split into two nature of business, the hotel property and the hotel service, right? After the proposal, you are left with hotel service. So I will need the asset beta or business risk for hotel service. Okay. But according to the question, you don't have business service. Okay, there's no beta for hotel service. Yeah, but we do have beta for property. Okay, so from here, we need to derive an asset beta for hotel service. Yeah, okay. Use weighted average of asset beta, what we already know. Okay. Okay, the overall is 0.61. Property is 0.4, correct? This is asset beta for property. Okay. Asset beta for hotel service is what we want to find. Yeah, we want to find this. Okay. The weight is given directly in the question. Okay. Hotel service 60%, property 40%, right? Okay, so the weight is given, we just use, yeah? Property 40%, hotel service 60%, okay? So by solving this equation, asset beta for hotel service, we can now found, which is 0.75, okay? And then we re-gear. Okay, we re-gear to the capital structure after the proposal. Yeah. Okay. Okay. We re-gear to the capital structure of Coiden after the proposal. Okay. 0.75, right? Re-geared, yeah? Okay, debt beta 0. Okay. Now, based on the question, it says assume the equity value no change. So still 42.3 million. Yeah. Equity value no change. Okay. So we just need to rework out the debt value. Debt should change because you pay off 70% debt. Yeah? So debt should change. Okay. Right. So I need to revalue the debt. Yeah. Okay. Okay. I do here. $5.20. 105.2. Yes. Okay. Yeah. Okay. I need the discount factor. The discount factor is cost of debt. Okay. So, okay, I put step 2 here. Okay. The cost of debt. Risk-free 4%. Okay. Risk premium. Okay. After you pay back 70% debt, your risk go down. It become A plus rating, which is 0.6%. Yeah. Okay. So the debt is lower, the credit rating improves. Okay. So after tax is 3.68. Yeah. 3.68. Right? Okay. But here should be before tax. Okay. Valuation ignore corporate tax. So it's 4.6%. Right? Okay. Okay. Market price divide 100 nominal times by the total nominal value after you pay off 70% is 12.6 million. Okay, so this become 12.8 million. Okay, 12.8 million. Yeah. Okay, so equity is 43.3, right? 12.8 million. Okay, equity 42.3. Okay, 42, 42.3. That is 12.8. Okay. So by solving this, you get the equity beta, yeah, 0.93. So that is the new equity beta, and the cost of equity is 9.58%. Okay. Therefore, the final step, WACC, cost of debt after tax 3.68, yeah? So 42.33 million, 12.8 million, okay? The total is 55, okay? Point, um, 13, okay? 55.13, yeah? So you get about 8.2%, okay? That, about 8.2%. So we've got the WACC, yeah? Okay. So now you need to compare the two. Okay. Okay. Right. You need to comment now. Okay. You are asked to comment on these two. Yeah. KE now 10.6. After is 9.58. So this one reduce, yeah? Reduce. Okay. Okay. WACC now 7.26. After is 8.2 is actually increased. Okay. So it doesn't go down as what the director suggests. Okay. Okay. Now, so you're asked to comment on the changes. Yeah. Okay. Let's start from KE. KE reduces from 10.6% to 9.58%. Now, always cost of capital reflect the risk. Yeah. So when the KE reduce means the risk of the shareholder reduce. The risk of the shareholders actually reduce after the proposal. Okay. Now, right. Okay. Why it reduce? Case where we got to analyze the risk. Yeah. I've explained in the earlier video, there are two types of risk: business risk and financial risk. Right? Business risk and financial risk. Yeah. Okay. There are two types of risk. Financial risk is the risk of debt capital. Okay. You have pay off 70% of the debt. Yeah. So you pay off 70% debt. So your financial risk will reduce a lot. Okay. So this should reduce. This should reduce significantly. Yeah. Financial risk is the risk of using debt capital. Since you have paid off 70% of your debt, this should reduce a lot. Okay. Okay. Now, then comes to business risk. See, at the moment, this hotel is operating on their own property. Yeah, you have sold off the property and you use leased property, rented property. So the risk is likely to be higher because it's not your own property anymore, right? The risk is likely to be higher. Okay, business risk is asset beta. If you look at the asset beta, yeah, the business risk. Okay, see, this is the asset beta now. After the proposal, just hotel service, the asset beta is 0.75. You see, it increased already, right? So the business risk is higher. Okay, higher, yeah. So, okay, you're moving away, yeah. Okay, last time is own property, now is lease property. Okay, so very likely the business risk increases. Okay, and this can be proven from the asset beta from 0.61 become 0.75. You put that to explain. Business risk is asset beta, remember, from 0.61 to 0.75. Okay, then you give an overall conclusion. Okay, overall it go down. Therefore, the reduction in the financial risk, outweigh the increase in the business risk. That's why overall it go down. Yeah, because that reduced 70%, that's a lot. So overall, the risk of the shareholder reduce. Right? That's one point. Yeah. Okay. Then you need to make a remark on the WACC. Now, we also know KE go down. Yeah, because you pay back 70% of your debt, you have better credit rating. Credit rating improved from BBB to A plus. So cost of debt go down. Yeah. But the WACC actually increases, right? The WACC from 7.26%, it increases to 8.2%. Okay. Now, since WACC is the average of cost of equity and cost of debt, cost of equity go down, cost of debt also go down. By right, when these two costs go down, the WACC should go down, but the WACC increase. Yeah. Now, so in this case, the only explanation to this is the M&M theory with tax. Still remember this one? The M&M theory with tax, which says this, WACC will fall like this. Yeah. The higher the debt level, WACC go down because the tax relief on interest costs. Yeah. So when your debt reduce, WACC increase because with lower debt, you pay lower interest, your tax relief goes down. Yeah. Lower gearing, WACC increase. Okay. So the only explanation we can have for this is M&M with tax theory. Okay. Loss of in tax relief. Loss of tax relief due to lower debt. Okay. So that is clearly explain the changes in the WACC. Yep. Okay, done. Okay, done. So when the cost of equity and cost of debt reduce, by right, the WACC should reduce. However, it actually increased. So the only explanation is the tax impact on the interest cost. Okay. Okay, the second question, part B, discuss the validity of the assumption that the market value of equity will remain unchanged after the proposal. That is, of course, very unlikely. Yeah. Okay. The market value of equity, we calculate using this model. Okay. We know the KE have changed, right? The KE has changed. So when the KE change, the value will change. That's number one. Number two, the free cash flow will also change. Yeah. Last time is your own property, you don't pay rental. Now you use a lease property, you must pay rental. So you have rental cost now. Last time you don't have rental cost. Okay. Your interest cost change because your debt has reduced 70%, right? So a lot of this will make the equity value change. Okay. So there's some explanation that we put down here, you can go through. Yeah. Okay, that is an example of how to evaluate a divestment. So as you can see, there's no new knowledge. It's all based on what we have learned already. Bye bye for now.